The Japan shock. How Tokyo's bond crisis is about to hit your wallet. The phone call nobody talked about on. January 20th, 2026. The United States Treasury Secretary picked up the phone and called Japan's finance minister, not to congratulate him, not to discuss trade policy. He was calling to beg. Beg for what, exactly? For Japan to say something, anything, to stop its bond market from imploding? Because in the span of a single trading session that morning, Japan's 3-0-year bond yield had just exploded by 30 basis points. The largest single-day move since these bonds were created back in 1999. Most Americans had no idea any of this was happening. It didn't make the evening news. It didn't trend on social media. But inside the world's financial institutions, alarm bells were screaming. Why would the US government scramble to calm another country's bond market? The answer is uncomfortable, because what happens in Tokyo doesn't stay in Tokyo. It shows up in your mortgage payment, in your 401 statement, in the price of everything you buy. And right now, it's just getting started. The $1.2 trillion secret. Here's something most Americans have never considered. Japan owns $1.2 trillion in US Treasury bonds. Let that number sink in. That's more than the combined market value of Apple, Microsoft, and Amazon. Japan is the single largest foreign holder of American debt, holding roughly 12.4% of all foreign-owned US Treasuries. For 30 years, Japanese investors have been among the most loyal, most consistent buyers of US government bonds. Banks, insurance companies, pension funds. They all lined up to buy American debt, and that steady demand did something remarkable. It kept American interest rates artificially low. Lower rates mean cheaper mortgages, cheaper car loans, cheaper business borrowing, a stronger stock market. The entire American economy has been quietly subsidized by Japanese capital for 3 decades. That era is ending, and the unwinding has already begun. How a country buries itself in debt and survives. Japan's debt-to-GDP ratio currently sits at 236.7%. No, that's not a typo. 236%. To put it in human terms, if you earned $100,000 a year, you'd owe $236,700 just in debt. And that doesn't include what you owe next year or the year after. Economists typically start panicking when a country's debt ratio exceeds 90%. Japan blew through that ceiling decades ago and just kept borrowing. For most countries, this level of debt would have triggered a full-blown collapse, currency crisis, hyperinflation, IMF bailouts. Japan avoided all of that through a trick so elegant it almost sounds like cheating. The trick: keep interest rates at 0. Always, forever. When your government owes a mountain of debt but pays 0% interest on it, the debt becomes manageable. It's like having a credit card with a 0% APR that never, ever expires. Except it just expired. The bubble that broke a nation. To understand how Japan ended up here, you have to go back to the late 1980s. Japan was on fire. The economy was roaring. Japanese companies were buying Rockefeller Center, major US film studios, golf courses across America. The stock market doubled. Real estate tripled. And at the very peak of the madness, the grounds of the Imperial Palace in Tokyo, a patch of land you can't even walk on, were worth more than all the real estate in the state of California, combined. Then the bubble popped. What followed was something economists call the lost decades. Deflation took hold. Prices didn't just stop rising, they started falling. And here's the trap nobody warns you about. Falling prices sound wonderful until you realize what they do to an economy. When prices fall, people wait to buy things. Why buy a TV today when it'll be 5% cheaper next month? When consumers stop spending, businesses stop selling. When businesses stop selling, they lay off workers. When workers lose their jobs, they spend even less. The spiral tightens. Japan's deflation lasted from the early 1990s well into the 2010s. An entire generation grew up in a world where prices never rose, where cash was king, where the normal rules of economics seemed not to apply. The Bank of Japan's response was extraordinary. They slashed rates to zero. They printed money on a scale the world had never seen. They introduced yield curve control, essentially capping how high bond yields could rise by agreeing to buy unlimited bonds to enforce that cap. The result? By late 2024, the Bank of Japan owned 46.3% of all Japanese government bonds. They weren't just participating in the market, they had become the market the day inflation showed up in Japan. And then, after nearly 30 years of waiting, inflation finally arrived in Japan. The rate has been running around 3%. That sounds modest by American standards, but in Japan, it's seismic. It's the equivalent of a country that had never experienced an earthquake suddenly being hit by one. The Bank of Japan raised interest rates in December 2024 to 0.75%, the highest level since 1995. They stopped buying bonds aggressively. They shifted from pumping money in to slowly pulling it back out. And the bond market noticed. Japan's 30-year yield hit 3.91% in January 2026, the highest since these bonds were introduced. The 40-year yield crossed 4% for the first time in history. The 10-year yield climbed to 2.12%, not seen since 1999. For a bond market that had lived at zero for 30 years, these are earthquake-level moves. There was also a political spark. Prime Minister Sai Takaichi announced snap elections on a platform of tax cuts and new spending. Bond investors did the math instantly. Bigger deficits mean more bonds flooding the market, more supply means lower prices, and higher yields. The bond market rebelled in real time. Some analysts compared it to what happened in the UK in 2022, when Liz Truss announced unfunded tax cuts and the market crashed her government within weeks. That's the world we're in now. The trade that built America's cheap money era. Here's where this stops being a Japan story and becomes your story. For decades, Japanese institutions have been running one of the most profitable trades in the history of finance. It's called the yen carry trade, and it works like this. You borrow money in Japan at near zero interest rates. You convert those yen into dollars. You invest those dollars in US Treasuries, yielding 4% or 5%. You pocket the difference. Repeat endlessly. Let's make it concrete. A Japanese pension fund borrows the equivalent of $1 billion at 0.1% interest. They invest it in US Treasuries, yielding 4.5%. That's a 4.4% spread, roughly $44 million a year in profit, with minimal risk as long as exchange rates stay stable. Now, multiply that across every Japanese bank, insurer, and pension fund. Add in hedge funds using leverage to amplify the returns. You get an estimated carry trade of somewhere between $500 billion and at the high end, $20 trillion. That enormous flow of money has been quietly suppressing American interest rates for 30 years. Every time a Japanese institution bought a US Treasury bond, they pushed American yields down and made your mortgage a little cheaper. Now, do the math with today's numbers. Japanese 30-year yields sit at 3.48%. Once you account for currency hedging costs and transaction fees, the spread between borrowing in Japan and investing in America has almost completely disappeared. The free money is no longer free. And a Japanese pension fund has to ask itself, why take on currency risk and cross-border complexity when I can earn nearly the same yield at home in my own currency with zero risk? Increasingly, the answer is, I wouldn't. The preview we already saw. We've already seen what happens when this trade unwinds, and it wasn't pretty. In August 2024, the Bank of Japan merely hinted that it might tighten policy, just a hint. The yen strengthened rapidly, forcing investors to exit their carry trade positions in a hurry. Bitcoin crashed 23%. The Nasdaq fell 10%, the S&P 500 dropped 8%. It happened fast and it was brutal. Traders who had never heard of the yen carry trade suddenly found themselves losing money because of it. And here's the thing, that was just a preview. A partial, accidental unwinding triggered by a single ambiguous statement. A full, deliberate unwinding, the kind now underway as Japanese domestic yields make the carry trade economically pointless, would be significantly more severe. Meanwhile, the US is running annual deficits of around $2 trillion. Total national debt stands at $38.6 trillion. The Treasury has to sell bonds constantly to finance spending and roll over maturing debt. Losing Japan as a buyer puts upward pressure on yields because remaining buyers demand higher returns to absorb the extra supply. And it's not just Japan stepping back. Europe holds close to 40% of all foreign-owned US Treasuries, roughly $8 trillion. European governments are now under pressure to dramatically increase defense spending. Where does that money come from? One answer, selling US Treasury holdings. The two largest foreign holders of American debt may both become sellers at the exact moment the US needs to sell more bonds than ever. How this hits your kitchen table? Higher Treasury yields don't stay on Wall Street. They come home to your kitchen table. Mortgage rates track the 10-year Treasury yield closely. As of early 2026, the average 30-year fixed mortgage sits at 6.11%, and it's been climbing. Every 1% rise in mortgage rates on a $400,000 home adds roughly $250 per month to your payment. Over 30 years, that's $90,000 in additional interest. Gone. Stock valuations are sensitive to rates because of how investors calculate what future earnings are worth today. When rates rise, future earnings are worth less in today's dollars, meaning stocks should fall even if the underlying companies are doing exactly as well. Corporate borrowing gets more expensive, which means companies invest less, hire less, and sometimes lay off workers. And here's what worries sophisticated investors most. The traditional safe harbor of bonds may not work the way it used to. Normally, when stocks fall, investors flee to bonds, cushioning the blow to your portfolio. But when the concern is rising interest rates and government debt, both stocks and bonds can fall at the same time. Ken Griffin of Citadel has explicitly warned about this. When bonds start moving in the same direction as stocks, they lose the one thing that makes them valuable. Then, factor in Japan's demographics, and the picture gets darker still. Japan's population peaked at 128 million in 2010. It's now around 122 million and shrinking. By 2050, it could fall below 100 million. The median age is 49. Japan now sells more adult diapers than baby diapers. Last year, fewer than 687,000 babies were born, the lowest since records began in 1899. A shrinking workforce means less tax revenue at exactly the moment when pension and healthcare costs are exploding. The IMF projects Japan's interest bill will double between 2025 and 2031. Japan cannot grow its way out of this. And as the pressure builds, foreign investments, including US Treasuries, become the first thing to liquidate. 3 futures, 1 direction. So where does this end? There are 3 broad scenarios. None of them involve things going back to the way they were. The most likely outcome is a slow grind. Japan carefully manages this transition over years, raising rates gradually, letting the carry trade unwind in an orderly fashion. The Bank of Japan has been navigating this extraordinary situation for 3 decades. They're not amateurs. Americans would feel the effects through gradually higher rates and a somewhat weaker stock market, but the adjustment would be manageable. This is the base case. It's what authorities on both sides of the Pacific are working toward. The second scenario is a faster unwind triggered by an external shock, a geopolitical crisis, a sudden oil spike, a political miscalculation. The kind of shock that forces Japanese institutions to dump US Treasuries rapidly. Yields spike. Markets sell off sharply. The August 2024 preview, but at full volume. The third scenario is a full fiscal crisis in Japan. Debt becomes unmanageable, the yen collapses, and the world's third largest economy enters a spiral it can't escape. Most economists consider this unlikely. Japan has high domestic savings, a current account surplus, and real technological strengths. But Japan's debt situation is unprecedented. We have no map for where we're going. Regardless of which scenario plays out, the direction is the same. The era of near-zero Japanese rates is over. The massive support Japanese investors provided to US Treasury markets is diminishing. Americans are going to feel it. What you can actually do. This isn't a call to panic, it's a call to pay attention. The shift underway in Japan is structural, not temporary. It will play out over years, not days. That gives you time to adjust, but only if you're paying attention while most people aren't. Rethink your 60 over 40 portfolio. When stocks and bonds can fall together, diversification into gold and real assets gains new relevance. Gold has already surged above $5,000 per ounce. There's a reason for that. Don't wait on rates. If you're considering a major purchase that involves borrowing a house, a car, a business expansion, recognize that the assumption rates will fall back to pandemic-era lows is probably wrong. The cheap money window of 2010 to 2021 was an anomaly created by Japanese capital flows, not a permanent feature of the world. Prioritize quality in your portfolio. Companies with strong balance sheets and low debt will weather rising rates far better than leveraged companies that relied on cheap borrowing to juice their returns. Watch the 1-0-year Treasury yield. If it moves sustainably above 4.5%, and especially if it approaches 5%, that signals significantly tighter financial conditions ahead. Those flows are changing now. Most Americans have no idea. Now you do.